Is there anything left for U.S. inflation data to tell us after 2 months of tremendous rate cut speculation? Is there anything that we're going to get out of this data that's going to change the narrative or alter it in some sort of a critical way that could maybe elicit a response from markets? We're going to find out and consider that maybe the data doesn't need to actually have substance to it in order to influence a significant reaction. Welcome. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And we're going to put the spotlight here on the PCE inflation data set, the personal consumption expenditure measure. This is the Fed's favored gauge of price growth. Obviously, CPI, the consumer price index, is the more ubiquitous one across major economies. But this one is the one that the Fed actually targets. When it talks about 2% inflation, it's talking about this. So we're going to get an update. We're going to see what the likelihood is that it goes this way or that. Then we'll see how it might register in markets and what the response could be on what will be the last day of trade before we really enter the Christmas and New Year holiday closures that drain liquidity from financial markets really everywhere, all across the world. So let's begin with just an understanding of what it is that's on the menu here. This is the PCE index year on year. It's broken down between headline and core. Headline is everything. Core excludes volatile food and energy, and ostensibly is what the Fed cares about because it can't very much have influence over global food and energy prices. And then the breakdown between goods and services tells you where inflation remains. So you can see here that when we consider the influence of goods, it's at this point negligible. There is no goods inflation to speak of. And so, not surprisingly, it's the service sector where the Fed is focused, not only because the goods side is difficult to materially impact, but because the service side is where there's still something to do. The expectation is that the headline number will come down to 2.8%. That'll be the lowest since March of 2021. The core number expected to inch down to 3.3. That's the lowest since April 2021. And of course, it should be very notable that for the first time in a long, long time, the headline number will have a 2 handle on. Since, of course, the Fed is trying to get to inflation that averages 2% in the medium term. Now, when we take apart what's inside that services section, what we see is that it's very, very skewed. So that service sector inflation rate by itself, most recently, is running at about 4.4%. And we can see what the lion's share of it is. That's that big orange thing in the middle for housing and utilities. And most of this is services having to do with housing upkeep, as well as a component that is a kind of estimate of housing cost that surveys folks that are owner-occupiers and essentially says, if you had to pay rent for this same residence rather than own it, or in other words, if you were to rent this out, what would it cost? And in that, get a sort of monthly gauge on what is the cost of housing. Now, if we actually look at the details here, we can see, needless to say, almost 2% of this services contribution to inflation is this housing and utilities thing. And the Fed doesn't really have much influence here because most of this is actually their own doing. The overwhelming majority of this is actually the disconnect between mortgage rates that people have locked in and mortgage rates available now in the market in the wake of the Fed's rate hike cycle. If you wanted to go and get a mortgage now, you'd be looking at rates somewhere in the 7 to 8% range. The average interest rate on outstanding mortgage debt, where in the US it's typically locked in for 30 years, is under 4%. So, needless to say, people are very motivated not to incur new mortgage debt. They're very motivated to stay in their homes, not to sell them. So, not surprisingly, there is a shortage of housing inventory since nobody wants to sell and refinance at double the mortgage rate. And so you end up with housing costs that are elevated, and you end up with housing services very much in demand because people want to do everything they can not to leave where they are, and therefore to spend on things like home improvement, construction, et cetera, et cetera. It's a similar story in financial services and insurance, where used cars are a comparable influence. Because interest rates are much higher, people are trying to keep their cars, as opposed to finance the purchase of new ones at these much higher rates. That does two things. Number one, again, there's a shortage. And so you have this contribution. Number two, insurance claims on older cars are, of course, more expensive. Insurance premiums on older cars are more expensive because they're older and more likely to break down. And so you get more expensive contribution, higher inflation in that sector. The Fed can't really do much about this because it is its own rate hikes that have taken us here. So instead, the Fed is focused on the other big part of this, the labor market. And this, of course, has been the main story. We can see that as we were coming out of COVID, a significant oversupply of labor, you see that in the blue bars here, reaching towards 17 million in early 2020 as the pandemic started and everything got locked up and everybody got sent home. Lots and lots and lots of labor, not a whole lot of demand. As the economy reopened, the pendulum swung the other way. Lots and lots of demand, and now a worker shortage. Lots of people on the cusp, lots of baby boomers on the cusp, retired during the pandemic lockdowns, and various other things, of course, including work from home and other sort of post-pandemic forces made for this. And so you look at the situation and you see that the stickiness of this shortage has meant that we still have a deficit of workers somewhere to the tune of about 1.5 to 2 million, give or take. And what that's done is it's kept the ECI, the employment cost index, much more elevated, much more stable near its highs than what we've seen from overall inflation. Again, here's PCE. You can see the headline has come down from 7.1 to now expected at 2.8. The core has come down from 5.6 to 3.3. But the employment cost index has shed less than 1%. So this is where the Fed is focused. This is really the object of the rate hikes, to slow labor demand, to slow the economy thereby to reduce demand for labor, and thereby to close this gap and cool inflation that way. And ostensibly, all of it is working. So the economy, looking at the latest PMI data, is near standstill. This, as ever, is working in the usual logic for how diffusion index PMIs work. So 50 is the center line. There you have neither growth nor contraction. Above 50 is expansion. Below 50 is contraction. The further you go above 50, the faster the expansion. The further you go under it, the faster the contraction. So what you see here is that the manufacturing sector still shrinking, the service sector growing modestly after a significant cooling off from a peak in May. And what that's given us is an overall economy that's kind of idling near standstill. So if the Fed was after a slowdown in economic growth, it got it. Here we are. We can see the peak, of course, May 2021. And then as the Fed starts to really cut, or to really hike rather, in earnest in early 2022, growth grinds down and stalls. That this is going to show up in a cooling of the labor market, that seems to be occurring as well. In fact, just earlier today, we got an update on jobless claims. And what we see here is that, in particular, the continuing claims number has really jumped. In the red there is the 4-week average that shows you that in the second half of the year here, there has been a blistering rise in jobless claims at the continuing part of it. And that's very important because while initial jobless claims, so people first filing for unemployment insurance, give you a sense of how many people are being let go, the dynamics with this shortage of workers that we were just looking at has been people leave jobs, they briefly initiate jobless claims, they quickly find another job. So it was relatively uncommon in this post-pandemic period for people to really linger on benefits for very long, because the shortage meant that employers were competing to get at scarce labor, and so people were finding their next thing after leaving their earlier thing relatively fast. What we see in the second half of this year is that the dynamic has changed. The sharp rise in continuing claims says the labor market is in fact cooling because people are having a hard time finding that next thing. Jobs have become scarcer. So this now seems to suggest that, again, everything that the Fed has been trying to do is working. The market is really screaming as much if you look at how Fed policy expectations are behaving relative to expectations for inflation. So in the green there, you have the 12-month outlook for Fed policy. And we can see here that over the course of the second half of the year, the 1-year look forward has gone from saying rates are going to be at 5.2 1 year forward to rates are going to be 4 1 year forward. So this is, needless to say, envisioning a significant decline in interest rates, in particular centered on next year. Because, of course, if you were looking at where this peak is at 5.2%, somewhere around September, it's essentially saying rates will still be above 5% in September of 2022 24. That was the forecast then. Clearly, now, just 3 months later, with a 4% rate, there has been a tremendous amount of easing baked in that is expected to occur. What's very telling here is that as the 1-year outlook for rates has significantly fallen, inflation expectations have fallen also. There's the 1-year swap based inflation expectation. It's come down from 2.7 to 2.1. And there's the 2-year break even, where we haven't really gone very far, but we've basically idled in this kind of plus or minus a few basis points around 2% for really the better part of the second, third, and now going into fourth quarter. But even there, we pulled in within that range as rate cut expectations were swelling. So the market is ostensibly telling the Fed there is enough damage done here. At this point, even if you were to cut rates, inflation is not going to go up because the economy has been weakened and you've succeeded. You've deflated growth enough that inflation is now aimed at the target, give or take. 2.1% is very close. And of course, to get to the 2.1%, apparently now the markets need a dramatic cutting cycle. So if the Fed weren't going to cut quite so aggressively looking at this, you'd get to 2% harder and more painfully. So the markets are screaming, this is it. The Fed is done. Mission accomplished. And so not surprisingly, as the Fed has started to first cautiously and later this month much more overtly signal that it agrees that it's done. At this policy announcement in December, the Fed's chair, Jerome Powell, overtly said, we're hopeful, we think that we are either at or very close to the peak in the rate hike cycle, which is, of course, something of a milquetoast way of saying it, but central banks are not in the business of going out there and looking like swashbucklers. They keep a muted tone so that the markets don't run away with speculation any more than they already have. But the messaging here was easily the most dovish than we've heard from the Fed in years. And so not surprisingly, what you see is a dramatic dovish shift in expectations. In the big dotted line there is where we were for the November FOMC, when the Fed first began to float that it's coming the market's way on the need for rate cuts next year. And then, of course, we see where the curve is now and where it was with the latest FOMC announcement on the 13th of this month. We can see it's only moved a little relative to December's meeting, but the gap between November and December is vast. We are expecting much more easing now than we did when November started. And the response from markets was, of course, emphatic. So what we see here in the gray bars is the amount of easing expected for next year. We can see we're now looking at about 1.5%. So the bars are now sitting at about minus 1.5. So that's 150 basis points in easing. That's 6 cuts at 25 basis points apiece. And we can see that as the markets start to price that in, as the gray bars begin to go deeper down, right at the start of that sort of shift as we round that corner, stocks surge at the prospect that there's going to be cheaper money ahead. So as the economy has been slowed, as we've just seen, there will be cheaper money to help cope. And so not surprisingly, the idea that earnings will be easier to finance, consumption will be easier to finance, all of that sends stocks roaring higher. It also punishes the US dollar because the yield advantage that the dollar enjoyed thanks to the aggressive Fed rate hike cycle first last year, and then in much of the second half of this year, at least the third quarter, going into the fourth, the diminishing rate cut odds that we saw as sort of the first part of this story right here, that clearly gave the dollar a boost, even as it sent stocks down right here. Once the pendulum swung the other way and rate cuts started to build out again, the dollar has been sinking. So naturally, the question then becomes, what's this PCE data going to do to change the story, if anything? Here's where all of this boils down. We already have an almost 90% chance of a rate cut by the March Fed meeting. A pair of them is almost certainly now on the menu for what's going on in May. 1.95 tells you that you have one cut already there and 95% chance for a second. 3 are there already baked in by June. 4 almost there by July. 5 almost there by September. 6 already priced in for year end. And January of 2025 carries a 79% chance for a 7th. This is a blistering easing cycle. That would imply that the Fed doesn't just start to dial back the tightening it's done to offer some more stimulus. No, this suggests the Fed is going to turn around and sprint in the opposite direction. Now, as we saw, we're looking for essentially more of what has been going on. Nothing controversial here as far as expectations. And as we've just seen from the dynamics of what's going on in the economy, everything seems to be working essentially according to plan. Nothing is really jumping out here to think that the economy is falling off a cliff tomorrow. Certainly growth has slowed, but that, of course, was the object of the game. The jobs market has cooled, but that was the object of the game. There's no sense of panic here yet. Maybe there will be, but there isn't at the moment. And so the question becomes then, well, you get a PCE number, and if it's hotter than expected, if let's say the headline is 3.4, 3.5, the core is the core is 3.4, 3.5 rather. The headline is, let's say, back north of 3. And suddenly 6 rate cuts seem like a lot. That would be an understandable catalyst to put this dynamic that we've been looking at into reverse. So if this comes out hotter, one would think there is some moderation to do on this. But what happens if it comes out basically in line or even softer? Well, the one thing that comes to mind is if it does come in softer, how many more rate cuts are we going to have? There's already one baked in for every meeting. Are we saying then that the Fed is going to, much less in the middle of an election year, cut rates by 50 basis points at some of these meetings? What kind of a crisis are we going to face that this is going to occur? There's not evidence of one immediately now, but for sporadic areas of concern here and there, and some sporadic indications here or there. Certainly nothing to stitch together a coherent view of risk being now already entering the markets. There are many potential pitfalls, certainly. There are many risks to this environment. But nothing is immediately sounding the alarm right now. So if the PCE number comes out softish, do we need any more cuts? If it comes out in line, do we need any more cuts? There's probably enough of them there already. If it comes out stronger, it makes sense that this unwinds a little bit. But perhaps so too if it comes in line, because there isn't much else to do. Meanwhile, this is really the market's last opportunity to do any kind of digesting of this rally that's been catalyzed by Fed rate cut expectations, if in fact it's priced in. And there's nothing else that needs to enter into this calculus as a consequence of the PCE data. Because, of course, we've gone a very long way, and the markets are surely not sleeping on the idea that every single time that we have had a Fed rate hike cycle in the modern era, since the demise of the gold standard and the Volcker disinflation in the 80s, every single time that there has been a rate hike cycle since, there has been a spike in the VIX with about a 2-year lag. Well, we're right in the window. And this comports with the Fed saying it takes between 12 to 18 months for a single rate hike to be fully absorbed. Well, that would mean we're again right on time for some kind of a stressor at some point in the beginning of next year, give or take. It would be exactly 2 years in March for when the rate hike cycle started. And of course, we can see here plainly from looking at the chart, it's not always exactly 2 years. There's a few months here or there in either instance. But if you're an investor looking at the current situation and saying, we've just had a blistering 2 months of rallying, and the catalyst for it has been swelling Fed rate cut odds, so much so that we now expect 6, and this PCE data doesn't really move the needle on that, what is to motivate the rally to continue? Maybe I want to lighten up a little in front of this kind of risk. And of course, because this shift, as the markets themselves would tell us, has been catalyzed not by some sort of a positive thing, that we are looking at a situation where inflation expectations are falling even as aggressive easing is being baked in, and that those inflation expectations are at 2.1% and not meaningfully lower, given the vastness of this easing expectation, suggests that there is a significant amount of weakness that is being expected. Otherwise, this amount of easing would send inflation expectations higher. And it's not. So A savvy investor might look at this and say, you know what? I don't know that there's going to be some sort of a crazy crisis next year, but it's been a great rally. This is probably the last liquid opportunity for me to take some profits off the table before liquidity falls through the floor for the holidays. As long as the PCE number is uncontroversial, there is a waypoint that's now in the rear view that I don't have to worry about as a piece of event risk. Let's take some chips off the board. And if that's the case, then even with a relatively inline number, you get some reversal of this dynamic. 6 cuts suddenly starts to look perhaps a bit heady, and you come in. That gives you stocks that come back some, and the US dollar that bounces. Now, of course, we'll see what happens, but it is the asymmetry of the risk, given how much easing expectation has been baked in already, that is most critical. It isn't necessarily the case that stocks are going to fall or that the dollar is going to rise unless there is an overtly hotter PCE number. But the risk that a number that doesn't move the needle on this narrative gives you a degree of digestive reversal seems greater than the alternative. Because how many more rate cuts could we need to price in, given how much has already been done? So unless the markets flatline entirely, the path of least resistance is asymmetrically likelier to favor a contrarian response to what's been going on versus the other way around. Which doesn't mean stocks can't levitate. It just means the risk of them going the other way seems greater. And that is Macro Money for today. It's also the last show for the week here. We're, of course, off for Monday around the holiday. We'll be back for a bit of next week while markets are open Tuesday through Thursday. Off again the Monday after New Year's. And then, of course, right back at it in January. We do this right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, talking about what happened on Wall Street on a given day and what it might mean going forward. Back on with Chris Fridays for Futures Power Hour, on with Tom and Tony for First Call, which is now on holiday until January. Writing for the news and insights section of tastylive.com, and opining on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining, everybody. See you next week. Happy holidays.